Hi folks, so today is 5th of February and we have the Economic Times newspaper editorial. So let's see what is written here. Most of the articles which we have today is related to the union budget, and this is one of that article. So reacting well to real challenges, at its core, Budget 2025 continues. Government of India's investment boost in the short term, strengthens manufacturing competitiveness in the medium term, and sets the stage for India to become a developed economy in the long run. So there are three motives. In the short run, it should boost the investment. In the medium term, manufacturing competitiveness, and in the long term, it should be able to develop the economy in the long run, right? So the budget aims to achieve these objectives while keeping the fiscal deficit within the 4.4% target, ensuring macroeconomic stability. India's public debt GDP ratio stands at 83%, with over 60% of the emerging economies and 40% of the advanced economies nearly 100% debt to GDP levels. These nations face significant interest payments, limit space for development expenditure, and higher for longer inflation. So, combined with the geopolitical instability and capital outflows to advanced economies, these countries face a higher risk of slowdown and macroeconomic instability. India, however, remains in a more comfortable position. Nirmala Sitharaman's 6-year fiscal roadmap reassures that the country is likely to maintain this stability. This budget outlines a 7% increase in spending compared to the current year, okay, signaling Government of India's commitment to growth through strategic investments. The short-term priority is to stimulate the consumption. The finance minister's aims to is to unlock the potential for higher disposable incomes for a large portion of the population through a wholesale revision of the IT rates, enhanced credit flow to farmers, urban street vendors, fishermen and women entrepreneurs, as well as strong package of measures to leverage the tourism sector. A key growth driver and employment generator over the medium term is the clean energy sector. Government of India has allocated 81,000 crore for the energy sector, a 31% increase from the current financial year's estimated expenditure. So development generator, right? And it has invested a lot, I mean, around 31% more than what it has invested in previous year in the energy sector. A significant portion of this is earmarked for a clean energy, with around one third allocated to the PM Surya Ghar scheme. The budget maintains a sustained focus on clean energy manufacturing, supporting ecosystem development through the National Manufacturing Mission and adjustment to taxes on batteries, solar modules, and wind turbines. The electricity distribution sector also receives a reformist push with the announcement of an increase in the borrowing limit for states, enabling access to 50-year interest-free loans from Government of India if state governments undertake reforms. This is a strategic step to ensure long-term energy security and a smooth transition to cleaner energy resources. Government of India also announced plans to deploy five indigenously built smaller nuclear reactors by 2033. So five small nuclear reactors by 20 and allocated 20,000 crore for R&D. So this forward-looking initiative is crucial for decarbonization as nuclear power offers 24 by 7 generation with zero carbon emissions. With improved safety standards and advances in the technology such as the uh, energy in conjunction with the renewables is a viable alternative to coal. There has been ongoing debate about factoring or services as its primary growth driver. Given India's success in electronics manufacturing and software sector, both industries have significant growth potential. Government of India has wisely pursued a balanced approach by announcing initiatives for both manufacturing and services, including measures to support GCC and the manufacturing sector. So incentives for capital goods manufacturing are particularly noteworthy. India's needs to start producing machines that enable final stage assembly in sectors such as pharmaceuticals, clean energy, and auto. Two other long-term focus areas in the budget are education and skilling. As highlighted by Economic Survey, India's demographic dividend offers a unique opportunity with 65% of its population under 35 years and a median age of 28. However, it is essential to align skill development initiatives with evolving labor market demands. Okay, so Government of India has allocated rupees 1.28 lakh crore for education, accounting for 2.5% of total expenditure. Initiatives such as broadband connectivity for all government schools, collaboration between skill councils, and establishment of centers of excellence for skilling with help India make the most of its youthful workforce. The budget's emphasis on boosting agriculture, unleashing in entrepreneurship and manufacturing, increasing exports and undertaking critical reforms positions India well to navigate global economic challenges while paving the way for future balanced growth. Budget 2025 sets a strong foundation for growth, innovation, and resilience. Okay, let's see. At its core, Budget 20 continues governments of India's investment boost in the short term strengthens manufacturing competitiveness in the medium term, right? So in the short term, it is boosting the investment. Short term, then in medium term, it is using the manufacturing sector, and in the third, which is in the long run, it is developing the India. Okay, so this is all for this particular article. Now let's see the other one. Keep calm and cut interest rates. So two events over the last week, the budget followed by a flurry of tariff announcements from the US are likely to have given RBI pause for Vipassana, thought and introspection. What has it gleaned from the news heavy week and what does the future hold as it emerges from a period of deep contemplation at its next MPC meeting this Friday? Let's start with the budget announced against a difficult economic backdrop. Global uncertainty warranted micro stability by sticking to the fiscal consolidation path. Weak domestic growth called for policy stimulus. The budget tried to do it all. It gave a meaningful consumer stimulus by lowering the IT burden on the middle class, held on to the capex thrust, and announced its intention to lower fiscal deficit. How did Government of India fund the large tax cut? It cut current expenditure to fund the tax breaks. As the year progresses, capex could turn out to a shade lower. To cut a long story short, because fiscal deficit is being cut, consumption stimulus is being funded by an expenditure cut. So this leaves us with the fiscal impulse that's neutral at best. RBI is likely to see this clearly, but will itself ask whether it needs to do anything about it. Which brings us to growth. The September quarter was a disappointment with GDP growth slowing to 5.4%. Since then, there have been some improvements and the December quarter growth is tracking at about 6%. However, is this enough? So India's ability to grow sustainably is higher at 6.5%, and the current growth gap can be filled by cutting rates and easing liquidity. RBI may want to trade carefully. Yes, it wants to support growth, but its primary mandate is inflation control. Luckily, a cool winter and full reservoirs promise a strong winter crop. In fact, January inflation is trending at about around the target of 4%. So yes, RBI has a green light to ease monetary policy and support growth. In fact, it took a slew of steps to ease liquidity. But then came the tariffs. Over last weekend, Donald Trump announced tariffs on Mexico, Canada, and China, which saw the dollar soar, putting emerging market currencies under pressure. The next day, some of these tariffs were put on hold and the dollar dropped. Okay. Sharply. India was not a key beneficiary here. So while India may have received a chunk of FDI in high-tech sectors, this was not the case in the more labor-intensive mid-tech sectors like textiles, toys, and furniture. Nevertheless, a new opportunity may be opening as global supply chains get rejigged once again. India can attempt to plug itself into mid-tech supply chains. However, this will only be possible if it dares to be different by choosing to remain open for business, even as the world becomes more protectionist. This entails Government of India keeping import tariffs low and stable, signaling bilateral trade agreements with countries like the US and being open to regional FDI. So RBI can also play an equally important role in keeping the rupee flexible. Benefits of freeing up interest rate policy to address growth rather than to defend the currency are well known. However, what is less appreciated is that a flexible exchange rate signals to manufacturers around the world that India's exports will remain competitive. It positions the country as an attractive destination to produce and export from. So should IFPI cut rates when the rupee is weakening? Yes, it should. Lower rates and a competitive rupee are both needed for strong, sustainable, and more diversified growth. Many of those going into Vipassana come back enlightened, no doubt, so will RBI. So that is all for today. Thank you.